Well, thanks for coming and meeting with me today. I just thought I'd
Sure.
kind of reach out and ask some of the common questions that a lot of people are asking about mortgages and that type of thing, and kind of get your opinion on it, and kind of give them some kind of info to I guess get them started in that process. So um,
So I'm Randy Key. I'm with Churchill Mortgage, Dave Ramsey's only endorsed mortgage company nationwide. I joined Churchill in 2008, so I'm going on 12 years now, I guess, of working up here. Myself and Mason Whitehead run this branch for Churchill. So we have about 30 of us, 35 maybe total folks here in Churchill, Texas, and we are located in Dallas, but we cover the entire state of Texas from here. So we serve all the Dave Ramsey listeners, really statewide, and even get into Oklahoma and Louisiana and New Mexico a little bit. So we're kind of the South Central office for Churchill.
okay,
So I am a branch manager, but I have originated loans for 12 years now and still do that about 50% of the time.
okay, cool deal. And that was one of my questions was how far do y'all expand, but y'all got a pretty good area to cover then.
We do, and part of our growth plan is to have physical offices in Austin, Houston, and San Antonio, and Tyler, Longview, Fort Worth, Midland. I mean, it's a huge state, so there's so much opportunity.
Yeah, for sure.
It just we had some growth plans in place for this year, and then COVID hit, and nobody wanted to do anything, and in terms of changing companies, and so we really have kind of been talking to folks, keeping the door open, but hopefully we'll grow and have some physical locations, and Austin's really our next target. So we're
Okay.
hoping to have a team join us that would basically become our Austin branch here pretty soon.
I gotcha. Well, that's cool. That's good
Yeah.
to hear. Yeah, I had a lot of plans for this year too, but kind of derailed that a little bit. But
Yeah.
I
A
guess
little different year.
Yeah, for sure. Let's just start with what are your main or your most common loan options that y'all have that are out there?
Well, the primary two are going to be conventional mortgages. That's the private mortgage. It's backed by Fannie Mae and Freddie Mac. That's kind of and gosh, I bet we do almost 75-80% conventional out of our mix. And then the others are government loans, meaning government backed, and the government makes the rules, and that's FHA and VA. VA is for veterans only. And then there's a program called USDA that's kind of a rural housing program too. So if you live in a major metropolitan area, it probably doesn't apply. But if you get out into the country, that's when USDA becomes an option. And that's another government program as well. And then you've got jumbo loans. Jumbo loans are loan balances that exceed $510,000. So if you're buying $1 million house and you want to put 20% down, Fannie Mae won't go that high. So that's when you get up into what we call jumbo loans, would be any loan balance 510 and up. And that's the say 99% of what we do.
Okay. Cool. And I mean, you said y'all do 75% conventional.
Yeah, which I was kind of surprised by that. I was looking at a funding report the other day, and year to date we're 75% conventional.
And do you
it's
know?
not that we market to that or really prefer it. It's just, generally speaking, if you got good credit and a down payment or equity in your house, conventional is the cheapest of the loan programs in terms of fees. So that's usually why if you qualify for conventional, we're always going to show you that that's the best option.
Yeah. And so I guess with that being said, what are the basic requirements for, I guess we can just focus on the conventional versus maybe the FHA for now. What are the basic requirements for those two?
Well, for purchasing, because you can do both, you can purchase a house with conventional or you can refinance a house with conventional. For buying a home, conventional is, if you're a first-time buyer, it's 3% down. If you've owned a home before, it's 5%. So both still pretty low down payment options there. And then FHA is 3.5% down. So really there's not a lot of difference in the down payment requirement between those two. And then VA, of course, if you're a veteran, is 0 down. And so is USDA if you qualify for a USDA loan. So down payment requirements are still pretty low given the mortgage crisis of '08 and kind of the tightening of credit that happened back then, and then now this year with being in a recession, and still doesn't take a lot of cash to buy a house.
Yeah. Have you seen any changes with COVID with the mortgage process or the mortgage loan?
No lasting changes. No, I mean, back in March and April when everything kind of first blew up, there was a lot of uncertainty, primarily around the government declaring, or I think it was called the CARE Act, which was where you could basically call your lender and say, hey, I don't want to make my mortgage payment anymore. And so that really kind of threw everybody for a curveball there, because I mean that's how this big servicers that own all the loans, that's how they pay for all the loans, is they collect payments. And they have even when they stopped paying, even when people stopped paying their mortgage, they were still responsible for paying the taxes and the insurance on those properties. So you got money that has to go out to pay people's taxes and insurance, and then all of a sudden people stop making payments. That puts you in a bind. And so there was a moment in time back then that March, April, that got pretty scary for the whole industry. And thankfully it kind of not as many people declared forbearance as we thought, thankfully, and so we kind of were able to weather that little storm there. But no major changes in terms of down payments or credit scores or stuff like that. The programs are pretty much still the same.
That's good. It's good to hear, because I know a lot of things kind of just froze right there, that March, April time frame, and nobody knew really what to do, didn't want to do anything. So
that's right.
I'm glad to hear everything's kind of getting back to kind of moving along, I guess.
It is.
There's probably not going to be a normal, but at least get back to some level of it. But
it's relatively normal again in our world. I mean, the outside world looks different with schools and churches and offices and all that. That who knows what that looks like going forward. But our world is pretty well back to normal in terms of lending guidelines and things like that. And really, rates are because of COVID and the recession that we're in, rates have been driven to all-time lows again. We feel like we say that every few years.
Yeah.
And here we are again with the lowest rates. I mean, most of us, if you'd have told us what rates are today, we wouldn't have believed you. They're that low. So
yeah,
we don't know how long they're going to stay here, but for now, we got them.
They're sitting around 3 right now, right?
Yeah, 30-year, with good credit and down payment and all that, about 3% on 30 years and mid to low 2s on 15s. Government loans, FHA and VA, are in the 2s on 30 years. I've done a couple of FHA and VA loans recently that were in the low 2s on a 30-year mortgage, which is insane. Wow. Yeah,
that's crazy. And to think, it was probably 15, 20 years ago, they were, above 10, right? Something crazy like that.
Yeah, it was probably 2005 is when rates really started dropping. And then, they were in the 5 to 8% range a lot of that time. When I started with Churchill in 08, rates had just dropped below 5 for the first time ever. And we were, the industry was just shocked. Nobody imagined ever seeing a 4 in front of a rate, and then all of a sudden, years later, we drop into the 3s, and nobody ever imagined that. And here we are in the 2s. So it's cheap money, cheap money to borrow it. That's the big question, Zach, is how much lower can they go? And we don't think they can go much lower, because at some point it just isn't profitable for these servicers and lenders to even make the loans. You get too cheap. So I think this is probably the bottom. and whether it lasts another week or two or another year, we don't know. But we feel like we're on borrowed time with these rates, because has been progress made, in early detection of COVID and making tests more yeah, just more readily available, getting results quicker, stuff like that. And I think there's a little bit of the fear factor that's starting to subside finally. The death rate is still incredibly low. I mean, below 1%. And we just this week, the CDC put out that out of that 1%, or that 0.5% death rate, whatever it was, that majority of those were really other factors. Somebody came in after having a bad car wreck and tested positive, but they died from the injuries of the car wreck, and they call that a case. So I'm hoping that the second, or this last quarter here we've got of 2020, the fear will continue to dissipate and lighten. And doesn't mean you don't want to be safe and be smart and wash your hands and sanitize and all that, but at the end of the day, it was just complete chaos and madness to shut the entire economy down, over something like this. And so I think as we see this start to as we start to come out of COVID and the fear-based world we've been in, that the economy will start coming back and that rates will go up. So I think we're probably toward the end of these rates.
With that being said, I mean, I don't recommend the balloons or any of that stuff anyway, but the adjustable rate mortgages and stuff, now would be the worst time to do that, correct?
Yeah, absolutely. I mean, when you can lock in cheap money on such long-term loans, 15, 20, 30 years. Yeah. I mean, plus we call it margin compression. I mean, the difference between 15 and 30-year rates is so little now. They've gotten, the 30 years gotten so low, and the 15-year can't go any lower.
Yeah.
So the same with the ARMs. The ARMs really aren't much lower than the 30-year fixed. And so we're not doing any ARMs. We really have never done many ARMs over the years, but certainly not a time to do them now.
Yeah, for sure. And so one of the most common comments that I hear is that you have to have a credit score to buy a house. And I guess, is that true? I'll just leave it at that. Is that true that you have to have a credit score to buy a house?
No, it's not true.
And so what does that process look like to do that without a credit score? Now, and you may explain that there's a difference between a credit score and a bad credit score, or a no credit score.
We certainly get a couple of times a week, we get the call that says, Dave Ramsey says you guys don't care about credit scores. So I want to get a loan, and we find out they've got a 400 credit score, right? And that is not what Dave Ramsey says. I mean, Dave doesn't care about credit scores. That's true, but he doesn't ever say, and has never said, that Churchill Mortgage can get you a loan with a terrible credit score. So he refers to it as a manual underwriting, and so what that means is that we essentially will create a credit profile, a credit history for a person by using alternative trade lines. So we use things like verification of rental history and utilities where you rent at your apartment or your rent house. We can use gym memberships, cell phone bills, all kinds of things that you pay monthly every month that aren't debt. And so we get generally 3 to 4 of those type accounts just in a 12-month history to show that you had an obligation to make a payment and you made it on time every month for 12 months. And we get 3 to 4 of those accounts to show that. And so that's called a no score loan, is what we call the product. And then we manually underwrite your credit history. And that doesn't give you a credit score. It's not like when we finish that you have a score, because you don't. It's just a way we underwrite your credit history and prove that you're a reasonable credit risk to make a loan to when you don't have a credit score.
For sure. And I think that's a lot of the misunderstanding, is that They say, okay, if I have a bad credit score, I can still get a loan. Well, that's not the case. You'll get denied even if you don't have any debt with a bad credit score.
Yeah.
We were at that spot. I don't know if you remember that when we first started talking, but we were at
Hmm.
that spot. We had a low credit score because we were paying everything off, and it was kind of climbing down. And then once it dropped off, we were able to start looking at the manual underwriting process. And we had a little bit of trouble in that space just because we didn't have the rent history because we were actually living rent free. So
Yeah.
it was a blessing, but then it kind of made it a little harder to find that loan. But
Yeah. And since then, we've been able to get the guidelines revised a little bit. We can do without housing. If you own one of the biggest cracks, in that program was for people that owned a house, but had no mortgage. And that generally wasn't, young people, first time home buyers. That was somebody that had lived in a house for 20 years and paid it off, had no other open credit at all, and, had no rental history because they owned. And so for that person, we can now use property tax payments to show that they've made property tax on the house on time. And then for folks that do rent, we have the ability now to use other trade lines without having to use housing. So that
okay,
has changed a little bit in the last couple of years since we worked with you last. And it's still a challenge because most of the people that call in for that loan are first time home buyers. They're young. Um, a lot of them will have things that aren't in their name, like they've got roommates and like their roommate set up the utility bills, and so the utility bills aren't in their name even though they pay for half the utility bill. Or you've got a married couple and the stay-at-home mom calls and set up all the utilities, so the guy with the income has none of that under his name because the utilities are all in the wife's name. I mean, there's a
yeah,
lot of squirrely stuff like that you have to work through to make them work. But we do a lot of them. So
yeah,
certainly do not, the advice of our competition when you have no score is to go out and open 2 credit cards and wait a year, because Fannie Mae and FHA both want not just 1 open account, but 2 open accounts for a minimum of 12 months. So
yeah.
that's what the big banks and our competition will tell you to go do. And we thankfully have a product to avoid having to give them that advice.
Yeah, for sure. And that's one of the things we were told a countless number of times was to do that, and but I was not where I was going to go.
Yeah.
um, so I guess we talked about the arms, but is there anything else that you know of that you want to steer clear from? I guess in the mortgage loan industry.
Not really. Thankfully, in 2008, when the subprime bubble burst and we had the big mess from 2008 to about 2010 or 11, thankfully regulations hit our industry hard. A lot of them were, created unnecessary red tape and just were a pain in the neck. But some of the good things that did come out of those changes were that they did away with a lot of the programs that they consider, unsafe for consumers. So like, back in pre 2008, you had loans that had prepayment penalties on them, meaning if you paid extra or paid the loan off early, you had to pay these fees and penalties. Prepayment penalties are no longer allowed on residential home loans. Um, they had all these stated income loans and no income, no asset loans. And I mean, all these really creative, use that word loosely, creative, right? Products. And that's all gone. So really it's fixed rate mortgages that you can pay on early. Not a lot of, products out there in the market that a loan company might steer you to, that would be detrimental to your future. Most of that's gone. I mean, really there are downsides to all programs, right? I mean,
Yeah,
so really when you're working with a loan officer, our team here at Churchill Mortgage, the first thing we start with is just educating you on your options. And so for some people, VA might be a really good option. For other people, it might be a terrible option. And VA or FHA or conventional might be a better option. So really just understanding the pros and cons of each of the programs, and kind of guiding you into the best fit, lowest fees, best payment, or best rate, lowest payment, things like that are going to be the counsel you want from your lender. And
Yeah,
there
for sure.
really isn't anything out there right now that's a dangerous mortgage product. Now they could start coming back. I mean, you never know. The future has a short memory sometimes, or the
Yeah.
lending, the
Well,
lenders in America seem to have a short memory. So we could start seeing some of that stuff come back, but it hasn't yet.
I mean, they're always going to try and find ways around the laws and do things, you know, differently to make things work. And so that's what you'll probably see is people, you know, working around the current laws to do things differently. But
Yep, that's right.
so you always got to be paying attention to what you're looking at and what you're getting handed. But having a good mortgage loan officer is uh, having one that's on your side and it kind of teaches you about it rather than just hands it to you and wants you to sign it. That's the best place to be. So, and that's why what kind of while we're doing this, I wanted people
Yeah.
to get some information around it, not just go in blind and whatnot. But
Yeah, the heart of the teacher approach that Dave takes, we kind of plagiarize that and use it around here all the time. Is we're not salesmen. Our loan officers here on my team are not selling anything. You know, it's a process of educating on options and then guiding you through the process. And that heart of a teacher approach is really what differentiates us and our guys here to our competition.
yeah, for sure. I know it was definitely. I mean, I think we spent probably a year of back and forth talking with you guys, trying to help us get things figured out, and there was nothing but great help and information coming from y'all's way. So it was definitely a plus.
Glad to hear that.
Um, so when does it make sense to refinance?
Well, good question. So, there's a kind of a rumor floating around in the world of consumer finance that if you can drop 1% your interest rate, then all of a sudden that's a magic, number and it makes sense to refinance. And I'll say that that's true some of the time, but not all the time. Examples of that are, if you've got a $500,000 mortgage, $500,000 mortgage, well, if you can drop a 0.5% rate, that's still $2,500 a year in interest saved, right?
Yeah.
Whereas if you've got a $50,000 loan, if you drop 1%, that's only $500 a year in interest saved. That's not very much. So everybody's scenario is different. When you refinance, you can lower the rate, of course, but you can also, there's other benefits. You can sometimes get rid of PMI. If you've got, home repairs that desperately need made, to your property, a lot of folks will do, cash out, take equity out of their home to use to update or take care of repairs. I mean, there's a lot of different things you can do, or a lot of goals you can accomplish from a refinance. We do a lot of 30-year loans to 15-year loans, so moving people from 30 to 15. And even if you're not dropping the rate very much, say they bought when 30-year rates were really low and you're moving to a 15-year rate and the rate's about the same, that's okay. If you look at a 15-year amortization compared to that current 30-year amortization they're on, they're still going to save a small fortune in
Oh yeah.
interest. So there's so many different things you can accomplish that's why we like to really get the every detail we can about the client and look at, kind of apply the Dave Ramsey baby steps to mortgage. And if they're light on reserves or have other debt, we kind of coach them, use the mortgage as a tool to kind of coach around the best solution for them. And sometimes a new mortgage is part of that. Other times we're just giving them kind of Dave Ramsey counsel and moving on to the next one if a refinance doesn't fit into that solution.
Yeah, for sure. And that's I've heard that 1% rule a lot, and I know Dave talks about it because it's easier for people to take in that is
Yeah.
kind of that boundary. But like you said, a $500,000 house or $1 million house, I mean, that's a big number, a big percentage. So it can still make sense.
Yeah, the math is always, what does it save me? by refinancing, what's my savings? What does it cost me? Because it's not free. If it was free, everybody would do it all the time, right? There'd be just
Yeah.
refinance 3 times a year whenever rates dropped an eighth of a point.
Yeah.
But there's costs. So what does it save me? What does it cost me? And then you divide those two numbers together and you determine your break even. So that's the conversation I have every single time, and I have for 12 years now with my clients is, all right, well, what are your goals? Number one, are you trying to get out of debt? Are you trying to shorten your term to a 15-year? What are your goals? And then when we get down to the nitty gritty of the mortgage, savings, cost, divide them together and determine that break even. And generally, if you can break even in 2 to 3 years or less, and you're going to stay in that home for 3 to 5 years or more, then it's a no-brainer. You want to
Makes
refi,
sense.
lock those savings in, because a lot of people that have a 3 to 5 year outlook on a property, life goes fast. And a lot of people that say 3 to 5 years are there 7 to 10 years, and
Yeah.
so that savings they broke even on in the first 2 to 3 years, they get to capture and recognize for the next 3, 5, 7, 10 years, however long they're in the house.
And especially from going from a 15 or 30 to a 15, you're saving just that balance at the end. I mean, you're not,
Right.
the last 10, 15 years that you're not paying on it.
Yeah, even if you're not in it for 15 years, it's okay. Like if you're in a house for 5 years and then you sell, if you look at what you owed at the end of a 15-year, you were in for 5 years versus what you owed if you were in the 30-year for that 5 years, you'd have a significant more amount of equity in the
Yeah,
house that you can then roll to your next house
for sure.
by doing a 15 years. So a lot of people think that, oh, I'm not going to be in the house for 15 years, so I shouldn't do a 15-year mortgage. So we
And
like to correct that thinking quickly.
yeah, for sure. That's what I mean. Otherwise, you would borrow on that house for 30 years if you're not going to be there for 30 years, right? With that thinking.
Same
Um,
thinking, right? It's
but
Yep.
they're not making those connections.
No.
So when I guess we kind of talked about how to determine if it's good to refinance, but the best option is just to get in touch with one of you guys and kind of go through that scenario so that y'all can help decide whether
Yeah.
it is a good option.
That's right. There's zero cost to looking at it. We're not going to pull your credit. I mean, unless we determine it makes sense and it's good time to move forward. Yeah, we'll that's what we do all day, every day, is just talk through all these kind of conversations, figure out if we can use the mortgage as a tool to save you money.
Yeah,
So yeah, you can call our main line here, or just go to our website and fill out a little quick form there, and one of the guys or girls on our team will call you and help you talk through all that. And again, at the end of the day, if it doesn't make sense to refinance, we'll be the first ones to tell you. There's never a reason to push through and work on a loan for weeks at a time, that doesn't even make sense to do. So we'll let you know you're in good shape right where you are, and stay the course.
for sure. And so I know I've heard people, to talk about paying biweekly or, I don't know what they call it, re-amortize or restructure that payment plan to where they're paying biweekly. Does that help them? I mean, obviously you pay more, it does, but can you explain that a little bit, or do you know much about
Yeah,
it?
it's a servicing feature, so it's something you can set up post closing, with your servicer. And I think there's pros and cons to it. One of the pros to it is it forces you to make more. One of the cons to it is, and the reason Dave generally doesn't endorse it, is that there have been times in the past where, say you want to get it removed, say you want to go back to, just making your regular principal and interest payment on the first, and I've heard nightmare stories about clients that weren't able to go back. It was something the servicer forced on them forever. And you can accomplish the same thing by basically making one mortgage payment extra a year. So if you take your mortgage payment, divide it by 12, and make that amount extra every month, it's kind of like making bi-monthly.
Yeah,
I've always mortgages can be kind of rain or shine sometimes. So I've always done 30-year mortgages. And what I do is I pay my regular payment on the first, and on the 15th, I have an extra principal payment set up that goes out automatically. So it's kind of like bi-monthly, where it happens automatically. And that, the payments combined is we'll pay our house off in 15 years. But if I ever want to take that 15th payment off, that extra principal payment off, I can. It's very simple. Log in and unclick a button.
Yeah, for
Whereas
sure.
in the biweekly, you can kind of get stuck in that sometimes. And the reason the biweekly can be a good idea for some people is just because they don't have, they don't have the discipline to go in there and do it every month. If
Yeah,
it's going to come down to forgetting it, and never making extra payments, then the biweekly is probably better than nothing.
for sure. And so I guess with what you were saying on your situation, it really comes down to that discipline. And because one of my next questions was, why do we recommend the 15-year versus the 30-year? And I think it comes down to that discipline. You can always pay a 30 like a 15, but will you is the question.
That's right. And that's why Dave says to do the 15, is because everyone has great intentions of paying extra and paying off early, but few ever do. So the 15 years is a great product. But if for some reason you can't get comfortable about it, then that's where doing the 30-year or even a 20-year. They come in every 5 years. So sometimes if a 15-year payment's just a little too steep, we look at a 20-year or even a 25-year. And every 5 years you can shave off, helps quite a bit in overall interest paid.
Oh, for sure. And I think he talks about it where I think it's under 3% of the people that actually pay it off or try and do that early on that 15-year mark or something like that. I don't know where he gets the number, but it's somewhere in that low percentage rate. But
yeah, not likely.
That's the whole idea though, and that's where I've kind of come in with my clients, is helping them like build that discipline muscle of just budgeting in general. But and that's where trying to get them to understand how much it would save if they did pay it off in 15 is, it can be hundreds of thousands depending on the size of the loan. So I think that's what got me hooked on paying it off early. I want to do even earlier than 15, but that's a different animal. You really got to start throwing some money at it. But
well, the first step is get debt free other than your home. Get your 3 to 6 months emergency
absolutely.
fund, fully funded. Really work on maxing out retirement. You'll notice paying off your home early doesn't come until baby step number 6.
Yeah.
There's a reason for that. You want to make sure everything else is in order. And we have clients call in all the time that want to move to a 15-year. They're in a 30-year. They want to move to a 15-year, and we say, great, we love doing that. However, when we dig in a little deeper, we figure out that they're on baby step number 1, and they have no business moving to a 15-year. 15-year is going to just put them in more pain than they're already in.
Right. It's going to strap them down a lot tighter, and they won't be able to make progress.
They're going to make the 15-year payment on the mortgage, and they're going to continue to dig deeper in credit cards just to do that, right?
Exactly.
So, yeah, we always counsel. We'll do anything a customer wants. Of course, we're not going to tell them, we're not going to help them, but we always try to advise that we keep the baby steps in order, and paying off that house, moving into the 15-year, paying off the house early doesn't come until everything else is in order.
Yeah, it's all about that foundation. When you're building a house, you got to build the foundation first. So build your foundation on the finances, and then take the next step and go above and beyond where you can. But so does it, obviously we're kind of talking about that now, but does it make sense to buy a house before the debt is paid off, or before your non-mortgage debt is paid off?
That's a great question. I think it depends on where people live, the cost of renting in your city. What we see, at least here in Texas, often is that it's more expensive a lot of times to rent than it is to even buy. So I think it's a personal question that everybody has to really dig into their own finances and figure out is, hey, do we have a plan to get out of debt even if we buy? And if buying is going to cause you to go into further debt, it's kind of like that conversation about the 15-year. Moving to a 15-year is going to cause you to go even further into debt. And if buying a home is going to take you from $1,000 a month rent to $2,000 a month on a mortgage, and you've already got credit cards and cars and student loans and all that, then you'd probably be pretty crazy to get you. So you
Yeah.
either got to buy a house that's going to keep your payments similar to what you're paying in rent, or keep renting, I think is the answer. And but the challenge with that is, particularly here in Dallas but Austin and, a lot of the bigger cities are really expensive. You cost almost more to rent in some places than it does to buy a house and put it on a 30-year mortgage. And so, you could make an argument in that case that if you're keeping your payment the same, you're buying, in theory, you're buying an appreciating asset. So at least while you're, if it's a rent versus own comparison, if your mortgage payment's staying about the same, at least you have an asset that the balance is declining on the mortgage and the home price is going up. So you're
Yeah.
creating wealth that way. But it also just depends on how much debt they've got, right? I mean, so, if you come in, you got 50 grand in credit cards, then no, you probably shouldn't buy. You probably should focus on finding a really cheap place to rent and pounding down a debt snowball. So
Yeah, for sure.
I think that's a personal, and it also depends on other factors. Kids, how many kids you have? I mean, you have any medical expense, as part of people's debt ends up being medical expenses that they've had to put on credit cards. So it's not that they've been necessarily, out just swiping it at every department store. It's that they had some major medical event that caused the situation. And so each family's, situation is just different. So we like
Yeah.
to have that conversation one-on-one with them.
Absolutely. I think that's where I've come into is, you have to meet with them one-on-one, like you're saying, and discuss their situation. I mean, and a lot of times what I try and get people to see is when they compare the rent versus buy, maybe the payment's about the same. It's, 1,200, but then you're also taking on the ownership of the house.
Mm-hmm.
How old is the house? Is it, is it about the AC about to go out? Or you have to redo the floors. I mean, you have to start accumulating all these expenses that when you move in, you weren't planning on, you weren't having to do when you're renting. So if you're in baby step 2, you have to think about that. And can you cover, an AC going out or something to that effect?
Yep.
If you do buy a used house or an older house, that is. So
You gotta
it's
look
all
at
part of it. But
utilities can increase on a home, versus an apartment. So if you're used to $100 a month in electricity and you buy a house and it goes to $200 a month average, then that affects your budget, So yeah, all of those things are smart to look at.
And that's where I like to sit down and kind of just detail both of those out and let them see the numbers and or I guess the not opportunities, but the what could happen, the what ifs, I guess, and see if it really makes sense or if they just need to hammer down for, because the average person pays off their debt in 18 to 24 months. So if they can hammer down for a year to 2 years, then and knock out their debt, they can really get control and get in a better position to buy with emergency
absolutely.
fund and so on and so forth. But,
yeah, you see more of that than I do. We get kind of a snippet in time. When we talk to a client, your coaching business allows you to stay in front of them for a longer period of time like that. They usually call us for mortgage advice and either buy a house or don't, right? So I think that's all those points you bring up are really true.
I talked to a couple here recently, and they were asking me if they should buy a house, but they made the mistake of already going to look at it and walking through it and kind of getting to that point.
Yeah.
And all they had to do is say, yes, we want it, and let's make an offer. And so, but then they called me and started talking them through it. Well, they had like 20 or 30,000 in debt, and so it wasn't a whole lot. They just needed to budget a little tighter and actually just focus on their budget, and they could have it paid off in 6 to 8 months, and then another 3 months they'd have emergency fund and be ready to buy in a lot better position than now. So just kind of getting them. Now I don't know, I haven't heard back to see if they've pushed forward or kind of held back on it, but I know that that conversation was, we talked about the ownership and what that looks like. They were, it's a new house, so it's less risky of stuff going wrong, and so that's kind of where they were wanting to. And they've lived in a house they've hated for years, and so there's all these emotional things that come into play. I mean, they live in a 2-bedroom house with 5 boys. So
Well,
I totally get their push to want to move into to get out of that house, but
yep.
it was a great conversation though. So, but they can flip that whole situation around real quick if they're focused about it.
That's very true.
But so I mean, when we talk about a pre-approval, what is it? What do you mean by pre-approval, or when you're pre-approved? And then does that hurt your credit when you do that?
Pre-approval is a means that we have underwritten and reviewed income, assets, and credit. So basically everything but the property you're going to buy, we have taken a look at to make sure that we can get you approved to make that purchase. And there is no cost to it. However, there is a credit inquiry, but generally one credit inquiry on a person's credit is not going to hurt them.
Yeah.
You go out and you get 8 or 10 in the same week, particularly if they're not mortgage, if they're credit cards or store cards at your favorite store where you can get 10% off if you sign up for a card, that kind of silly stuff, like that can have an impact. The credit bureaus don't know how much money you make. All they know is you're looking to open new debt. And generally mortgages, they know you're not buying a whole bunch of houses at once. So if you have 2 or 3 mortgage inquiries around the same time period, shouldn't hurt you at all. So no, doesn't hurt your credit, no cost to it really. And they're good for about 120 days, so about 4 months. So we generally don't recommend you start a pre-approval until you're about 2-3 weeks out from wanting to start actually actively looking at homes.
Yeah. Not just a Saturday stroll when you're thinking 6 months from now.
Right. Yeah. If you call in and you got another 9 months left on your lease and you're just kind of kicking the tires, then we'll talk you through what goes into it. We'll even kind of pencil it out, let you know that, hey, you look good, or hey, you need to work on this area, that kind of thing. So we're happy to have those early conversations to get you prepared for the right time, or when the right time comes. But not a lot of point getting credit pulled, sending in all your pay stubs and bank statements and all that stuff, because by the time the time to start rolls around, all that stuff will be expired and we'll have to start all over.
Yeah, I think that was a key learning process for us during the manual underwriting process. Was I kept telling myself I don't need to call the mortgage people because we're not ready to buy a house. And I think if I called and started talking about the process of manual underwriting, then y'all would have been able to explain, hey, what do I need to have in line for that to happen? Because I know a lot of our conversations was, well, you need a year's worth of this or that, and I didn't have that at the time. And so that's one of the things I want to walk my clients through is that, are you planning to manual underwrite? And if so, let's start that conversation now so that we can kind of make sure your ducks in a row when you do get ready to buy a house. And kind of go that route. But
that's smart. And again, we don't ever mind. It's not a burden on us, or a problem for us to have a conversation a year out. I mean, in fact, no harm in it. Worst case scenario, you get told everything's good and call back in a year. Best case, you discover that there's an issue and you have some time, to work on it and get it resolved before you're ready.
Yeah, for sure.
So yeah, one of our home loan specialists can walk you through all the primary, categories of an approval, and you don't have to send in pay stubs, you don't have to pull in your credit, any of that. We can keep it real high level and just make sure that you're prepared for when the time comes.
For sure. And so with that being said, what is the normal process that people get started with this? They just kind of call or just go on the website, or?
Yeah, you call. Call if you want to work directly with me. Then obviously call and ask for Randy Key. Otherwise, you can, or if you're out of the state of Texas, if you're listening, you're not in Texas, and just go to our website. Again, there's a quick form you can fill out there. One of our home loan specialists from wherever you are will reach out, and or you can just call the main number that's listed on our website. Either way.
Okay, cool deal. That's about all I had in my kind of list of questions. I mean, is there anything else you can think of that people may want to know?
I think the realtor topic's important. You know, a lot of, if you're buying a home, a lot of folks have a lot of kind of just questions around what does a realtor do, and do I need one? And I would say the answer is yes. If you're buying a home, the seller pays for the realtor anyway. The seller, when they sign a listing agreement, will agree to pay usually 6% to the realtor. And if there's a buyer agent on the contract, when you get a contract on the house, the buyer agent gets 3% and the selling agent gets 3%. But what most people don't realize is, if you say, I'm going to go find the house my own on the internet and go up and I'm going to try to negotiate a better deal, well, the reality is you're not going to be able to get a better deal, because that seller still has to pay that listing agent the full 6%. So instead of getting to split it between a buyer agent and a selling agent, that listing agent gets to keep all 6%. So it's kind of a lottery win for that realtor, and it doesn't save you any money. So I would say absolutely have representation. Not only are they going to help you look around, you can do that yourself now with websites and tools. But when it comes down to negotiating price, they're going to be able to look up comps, tell you what a good offer is. They're going to help you negotiate the actual contract, complete it, all the option periods and third-party financing periods, and negotiating any furniture that, non-realty items, we call them, that you're going to keep, that the seller's going to leave. I mean, all that stuff. If you've never done this before, if you're not a real estate attorney or a real estate professional, you're going to get lost in that, and potentially could get, taken advantage of by the seller side, because that selling agent represents the sellers, not you. So Dave, you can go to Dave's website and find his endorsed local lenders, realtors there on his site. Or if you're in Texas, we've worked with a lot of them, and we have a network of great agents across the state that, if you call us first, which usually is the first step before you reach out to a realtor, normally you want to reach out to us, make sure that you can get financing, you can actually buy a house, and to help you determine the budget. Budgeting is a big part of our conversations on the front end. Is, not just can you buy a house, but what's your budget, and helping you figure out how much house that equates to. So we'll help you with the budget, and then usually at that point we always ask, do you have an agent? And if you don't, we always, or we'll be happy to make an introduction there. They're all, generally all Dave endorsed realtors that we know and, have worked with for years and trust. So lenders usually the first call us for the first step, and we'll help you through all of that. And then if you have an agent you've worked with in the past, or know and trust, then give them a shot. If not, we'd be happy to make that recommendation.
For sure.
Other than that, I think we kind of hit on all the other major topics.
Yeah, I think so. I mean, just the basic idea of, or do you have a basic idea of a budget? Like, how much can I buy? Like, where would you like to see people stay, or where do you tend to see people stay?
Well, if you're a Dave, fan, which we're Dave's endorsed lender, but not everybody that we work with even knows who Dave is. So we apply Dave when we can, and the rest of the time we just kind of apply his principles, really, without using his name. So Dave would say to keep your housing cost, which includes taxes, insurance, PMI, whatever you've got on the house, at 25% or so of your take-home pay. And I think that's a really wise, a really conservative payment. That leaves you with 75% of your income to live on.
Yeah, for sure.
Now I'll say that people stretch that, and everybody's budget's different. 25% may make sense for a family, a single income family with 4 kids, because you've got a lot of other expenses, whereas I've got single people that, have income and no other expenses. And they're like, well, I'm going to go a little higher. I'm going to go to 30 to 40% of my take home pay because I can, and I know my budget, and I don't have any kids, or I'm an empty nester, or whatever the situation is. And so it's different for everybody, but depending on how much in other liabilities or living expenses you have. You know, if you've got kids in private school and you got a big check you got to write for that, then you want to keep that housing cost lower. Or
Yeah.
if you've got a kid with special needs that has a bunch of medical expenses, you want to keep that housing cost lower because your other expenses are going to be higher. So I think 25% is a real conservative spot, and fine. You know, the lower the better, frankly. That means you're going to have more money to give and spend, or give and save, excuse me. But I wouldn't say that you have to stay there either. You know, every family's a little different.
And that's what I like to walk people through, is to figure out like what is the risk on, or what are their potential other expenses they may have to incur, because you don't want to go to 40% and then have to use credit cards to pay medical bills for your kids, and you're going backwards at that point. So you got to just pay attention, and that's the whole idea, is just paying attention to your budget and knowing where you are and how you your situation is, and then that's the key. But,
yeah, you got to know your numbers, right? I mean, you got to know your budget, know your numbers. You got to have goals. You know, I think this is part of what you do, but I've got a coach that that I work with personally that you know, my goal is to save 20% every month, minimum of 20%, give minimum of 10%, and so then the rest of my budget has to fall into that. I can't. I have to. If those two things aren't met, then I'm spending too much money on the rest of it. You know. So, bottom line, whatever your convictions are for giving and saving, have a goal and know your numbers. If you're just flying by the seat of your pants with no budget, that's where problems happen.
Yeah, big problems too.
Yeah, big problems that can cost marriages and cost, you know, big dollars later on.
For sure. Well, thanks for sitting down with me. I enjoyed it, and hopefully people can get some good information out of it. And I'll put some links in here for people to reach out to you and kind of get a hold of you and your team here locally anyway.
Yep, would love that. We're here in Dallas, and again, work the entire state of Texas for purchases or refinances. So
awesome.
Give us a call if you're listening and have any needs at all.
For sure. Well, I appreciate it.
Sounds good, Zach. Enjoyed it. Thanks for
all right.
having me on your show.
Yeah, no problem. Thank you very much.
See you, man. Absolutely.
Have a good one.
Take care.